you want to fish where people are going to fish later. And I mean that by, Columbus, Ohio was not the cool place to invest in 2015. But now, now we get calls every other week about people want to buy our properties in Columbus, Ohio from California and New York City phone numbers.
Welcome to Multifamily Insights. I'm your host, John Casman, and I want to thank you for joining us for another great episode. If you're enjoying the show, do me a quick favor, leave us that rating and review so we can hear what you love about the show, but also give us any feedback to help us make this show work harder for your investing goals. And if you haven't done so already, make sure you hit that subscribe button so you don't miss an episode. We've got an amazing show today. We're going to be talking to Kenny Wolfe. Now, Kenny Wolfe is an experienced multifamily syndicator, the founder and CEO of Wolfe Investments, and a published author of Investing in the Dream, How to Acquire Multifamily Real Estate and Attain Total Financial Freedom. Now, he invested in his first multifamily property back in 2010 and instantly saw the potential for real estate to transform his life, giving him the opportunity to quit his day job and start a company. Let's welcome to the show, Kenny Wolfe.
Awesome. Thanks, man. Appreciate being on here.
Absolutely. Hey, Kenny, I went over your bio at a very, very high level. Why don't you take 2 minutes and fill in some of those gaps?
Yeah, sure. So we've grown the company down to 675 million of assets under management today. Should be on track to beat the $1 billion mark by the end of the year. We do existing multifamily. That's where I started the company 13 years ago. And now we do also development, ground up multifamily and office conversions to multifamily in that same development arm. And then for our boring monthly cash flow, we have $54 stores, CVS, Walgreens as well. So
I love it, man. I love it. So you talked about really getting started, do you say 675 million in assets under management right now, on track to get to $1 billion by the end of the year? So kudos and congratulations there. It's a huge portfolio. You talked about doing mostly existing multifamily, but doing some ground up development as well as some office conversions, not to mention, some, you call it boring cash flow, but owning some Triplenet lease options like Walgreens, CVS, those kind of assets as well.
Right.
Let's talk about this journey to $1 billion, right? So obviously you started investing in multifamily back in 2010. And we mentioned that you saw right away how this was going to be a great platform for you to kind of quit your day job and start a company to create wealth. What was it about multifamily that really sparked to you immediately?
It's all about scalability, so with multifamily, especially the bigger properties, you get usually non-recourse loans. So if you take out a recourse loan, that actually hurts your ability to buy more deals down the road. So to be able to scale it with non-recourse financing was just phenomenal. That really spoke to me. Then also I'm an accountant by background. And so, commercial properties are basically traded and valued off their income statement, which spoke to me as an accounting guy. So I really enjoyed that piece to it, and then really just saw the value of where we can bring investors in, and I throw down with them every single time, but we have a group, we can all get wealthy together and each play our role, and really saw that. So I've never owned a single family rental in my life. I jumped right into multifamily. So 76 unit apartment complex in Dallas, Fort Worth. And really I talked to buddies that had single family homes and they all had headaches. So I didn't want to mess with that. So I wanted to my goal was to buy my first property with professional management, and with maintenance folks on staff. So that way we've got, I can focus on building the portfolio again to scale it as big as we have.
And that first deal, that was a 76 unit, you said?
Yeah, 76 units, yeah.
So listen, that's a shocker, right? I mean, you think about many people getting started in real estate, most people want to scale slowly, right? Get some single families, maybe some duplexes, starting with small multifamily, then eventually getting up into kind of the commercial multifamily space, and then scaling into larger assets. You started with the 76 units. So take us through that mindset, because I think that, I know for me at least, I read a book. You probably read it as well, as the ABCs of real estate investing, Ken McElroy, and some of those rich dad books. And one of the things they talk about is that you don't have to start small. You can start with these large apartment buildings. And I remember the first time I read that thinking, Yeah, right. Who would ever start and buy a huge property as their first deal? And as you gain more experience, you realize it does make sense. But where were you at mentally? I mean, I know it makes sense on paper, but what gave you the confidence and what gave you kind of the ability to go ahead and pull the trigger on a 76 unit
Sure. Yeah. So that 76 unit, we had to raise 825 grand, you know?
and raise money? So, first
Yeah.
deal, 76 units, and you raise money, your very first multifamily investment. Wow.
Exactly. I raised 825K. I'll never forget. That was the hardest 800 grand I ever raised in my life. But anyways, really it was, again, I wanted to start with a professionally managed property. That was always the goal. And really what prepped me for that, was I specifically sought out to passive investments in apartments first, to learn the ropes because I didn't know what the heck I was doing. So I wanted to learn that, and be a good steward of other people's money. So the first one I picked was a huge fixer upper. I was a passive investor. My hand was shaking when I invested as 100 grand, which at, 28 years old is a lot of money. And it's still a lot of money, but 28 years old, that's a lot of money. So invest in that huge fixer upper is like, we bought it for 12 a door. The pizza delivery guy wouldn't go deliver pizza because he'd get mugged in the parking lot. Like, it was cars on blocks. I mean, it was really bad, but it was the worst property on the block, right here in Dallas, Fort Worth, in Arlington there. And really it was, so that was that one, just to get experience with, what does a huge rehab look like? Who's the management company? Who's the team, the mortgage lending, the contractors, get that Rolodex of teammates there. And the second one, I specifically sought out a yield play, or a Fannie Mae backed loan, and which was very, very key. So I could see, okay, one, like, is the team different from a big rehab deal to a value add, deal? Both of them being, that one was probably a C plus, B minus asset, but the key there is that it was a Fannie Mae loan. And so my deal, my 76 unit deal, Fannie Mae counted that as my experience. So my first syndication deal, 76 units, I was able to get a Fannie Mae non-recourse loan. So which just set me on this track of, huge trajectory. Because again, you can hit that non-recourse button as many times as you want, that there's no, detriment to your balance sheet or whatever on that, your borrowing ability. And so that's really was, I figured out the team, got the Fannie Mae non-recourse lending, and then was ready to jump into my first syndication deal.
There's a couple of really, really great insights in there. So I want to make sure we all are processing what you said. So first of all, kudos to you. Congratulations on being able to crush that and having that mindset at such a young age, right? You talk about 28 years old, you're making your first passive investment. But the insight there is really that you knew kind of what you wanted to do. So you knew that, hey, this real estate thing, this is a great way for me to scale, for me to grow, for me to build this company and to quit my day job. So this is what I want to do. Instead of jumping straight into your own deal first, you actually invested passively in two deals. And I think your strategy in investing passive is really smart as well. First of all, were both deals in Arlington, kind of DFW area?
Yeah, both were in DFW. Yeah.
So both deals are kind of in your backyard. So you could actually drive around, understand the neighborhoods, kind of check out the property and see what's going on for yourself. So I think that was really smart for you. The second thing was two different types of properties with two different perspectives. One was more of a fixer upper, big time, heavy lift renovation project. So you're understanding what teams are working on that. What are the contractors, the property management team? How do they operate? And really starting to get a sense of, are they good at this, or do you need to make some changes? And then on that second deal was more of a yield play. So this one maybe less on the big renovation, more about the cash flow. And then this one was agency debt project. And you mentioned that they were able to give you credit for being an investor on that agency deal. So when you moved to that next deal, which was your own 76 unit, you were able to qualify for the loan. And I think those are just really, really important aspects to understand how to build traction. So if you're looking to scale and get started with a portfolio, the first thing I would tell you is consider investing passively, especially if there's someone in your market or someone that you have a good relationship with who is willing to teach you the ins and outs. It's not just about putting your money in a deal and crossing your fingers and hoping it works out, but you want to learn. You want to understand, hey, how's the property management company? Are they good with this? Are they good with this business plan? Who's good with this business plan? If we did a different business plan, who would I consider for that? So those are the kind of things that are going to help you get comfortable, build your confidence, and be prepared to scale your portfolio. And Kenny is a great example of how to do that. Kenny, you mentioned that the company, agency, or I'm sorry, the lender gave you credit for that deal. You were an LP on that second deal, right? Or were you more of an active role on that second
I
deal?
was, yeah, I was just an LP. I was just an LP in that deal. That's not always the case, but because it's when Fannie Mae looks at your track record to give you your first loan, they look at your, what apartments have you invested in before, like what's that, but they also look at your other business background. So I was a CFO at the time of an oil and gas company too, so I think that may have helped too. But yeah, I was just an LP in that deal.
So we have that right there, and I think it's important for people to understand that while we talk about that first deal, 76 units, you raised $825,000. The reality is you did have more experience, and you did have some knowledge and some team members that you were bringing to the table. So it wasn't that you were just, you just got on LoopNet, found a property, put an offer, and then called your buddies, your golfing buddies, to come
Right.
invest 825. Right? There's a little bit more work in there. Just talk to us a
Oh,
little about that raise, though, right? Because you mentioned it was the hardest raise you ever had. Given that this was your first deal as a lead operator and a lead sponsor, what were some of the challenges you faced going through that raise process?
sure. I mean, so as a newbie, as a new syndicator, new deal sponsor, whatever you want to call us, the your challenge is your track record, right? It's your first deal, so others going to ask you, okay, what deals have you done? Me at the time, I could point to those two passive deals, and then what really helped me, I believe, was that we bought that 76 unit deal. I was able to hire a professional management company. I can point to that. I said, Kathy currently manages 5,000 units in Dallas Fort Worth. And I could point to the lending team. These guys he's been a broker for 30 years. So I can point to all this, to all the teammates to bolster my track record, which wasn't very much at the time. I was a newbie, right? But by buying a bigger property with, the manager's going to take care of all the leasing and evictions and all that kind of stuff, maintenance guy, take care of all that. So we had professional folks on our team. I think that really helped be able to raise the money. And I think it also helped to point to a non-recourse loan as well.
Yeah.
Investors like to hear that, even though it really doesn't affect them. But it's still a good, it's a marketing thing, right? It's like the gym at your apartment complex. You'll never use it. No one ever uses it, but you got to show it. So
Yeah, you got to have it you got to have it at least on the website, right?
right,
And for the
exactly,
tour.
exactly.
Yeah, I think that's really helpful, right? So you talked about leveraging the experience of your team members, and this is critical, right? People want to know that you can build a great team, and I think this goes back to anyone in corporate America. You were the CFO, so you understood kind of the financial aspect of things and counting. I come from the marketing world, right? So I'm used to understanding the advertising, the marketing side of it. And the reality is that I wouldn't start a business where it was just me and there's no one who can help me with the financial side of things and understanding kind of the different departments, just like I'm sure you wouldn't start a business and you had no clue how sales and marketing and some of the other aspects of the business ran. You've got to
Right.
build a team around you, and it's the same thing here. So your experience, your knowledge, your background, it is what it is. You obviously want to continue to grow and educate yourself, but you also want to surround yourself with people and build a winning team of folks who can execute and deliver on whatever it is you are trying to accomplish. You obviously were able to do that on that initial deal. Let's fast forward a little bit here, Kenny, right? So you are scaling a company, you're on your path now to $1 billion. For those, syndicators, operators who are maybe a little bit earlier in their careers, have some properties under their belt, trying to figure out how to scale, particularly where, the market is starting to tighten up and get a little bit more difficult. Give us some of the tips and insights that you were able to implement to scale. I won't say so quickly, but to scale successfully and kind of manage and mitigate through that growth.
Sure. Yeah. I mean, really, it's about hiring the right folks. We've got 20 folks that work for us up here on the investment side. We're also vertically integrated, so we own the management company, and there's about 280 employees there. But on the investment side, we're at 20. Warren Buffett, I think, has 24, so we're cashing them pretty quickly. But anyways, it's really about hiring because there's only one of you, at least initially. I think it was right after my third syndication deal, I started hiring a staff member. And it really is the thing where you look as a business owner, what are your weaknesses, like you're talking about, where are your deficiencies? Mine was digital marketing, and I was tired of scanning my own documents in because this was before DocuSign. So I was like, all right, I need an admin, and she needs to also be a digital marketing person. So in a small business, you've got to wear everybody has to wear a lot of hats. So That, and then the third hire was asset management for multifamily, because we had already started owning in multiple states. So I was having to fly a lot, quite a bit. So I was needing to spread out and bring some teammates to help cover more ground. And then really just kept snowballing and really, building the team. So now, like I said, we've got three kind of real estate investment offering types. I've got managers across each one, and then multiple people below them now. So got quite the team we're building, and we're just hiring another lady here in a couple of weeks. So
I love it, man. I love it. And the insight there for me is that you identify kind of the pain points or the things you didn't enjoy doing,
right,
and found people who could do them better than you, or take this task off your plate, right? So scanning documents, administrative type projects, taking that off your plate, but then also
right,
someone who can do digital marketing, so they can help with the sales and marketing and help you expand and grow, maybe in ways that if you try to do it by yourself, maybe you'd be less effective. Maybe you don't really know what you're doing in that space, or maybe you're just, going to waste a lot of time and money versus hiring someone who has that knowledge and they can kind of grow it. So again, think about yourself, your own business. Where are you strong? Maybe where do you have some weaknesses? Can you bring on someone who can help take that and help elevate the company to the next level? Kenny, I think those are really, really important points here. When you think about kind of the current landscape, because again, you started back in 2010. I don't know how many syndicators were out in 2010. We started in this business more 2016, 2017. So you've seen a lot of operators and syndicators kind of come and grow over the last 12, 13 years. Talk to us about kind of, the change in the landscape and kind of the demand for apartments as far as investments are concerned, and whether or not that's impacted your own investing philosophy.
Sure. Yeah, no, it's a good question. Yeah, I mean, I tell new folks all the time, new wannabe syndicators, that it's always difficult. There's always something that's the challenge. So back then, the deals were on the market. We bought that our first syndication deal at 8.5 cap on the market, 1980s product in Dallas Fort Worth. So that wasn't the issue. The numbers made sense back then all day long. And then even without the cap rate compression, but problem was raising money, and lending was still coming out of its shell a little bit, right? So those were the two hurdles there. Today, or at least maybe go back a year. Today's a little bit different, but say in 2021, 2022, deals were flying around, but it was highly competitive. There were so many more people bidding on the same property and bidding up and up. And to me, it was, where's the real value? How many times can we say, call something an upgrade? I mean, we got down to like throwing in, like people were talking about, yeah, I'm going to throw in a Nest thermostat and charge $25 more a month for my value add. I'm like, come on, like, I don't know about that. But anyways, but you see but it was a highly competitive on that. And so that was harder to find like really good investments. And they were out there, but you had to really fight for them and dig. But the lending was easy and the equity was easy, right? So today in 2020, I know you want to make this evergreen, sorry, but in 2023, basically the deal flow shut off. I mean, the deal flow for multifamily assets for all of 2023 is going to be pretty anemic, just because everybody believes, and I'm one of them, that sorry about that, that the Fed's going to have to lower interest rates here in the next 9 to 12 months. And that's again, going to bring back a seller's market. So most of us bought rate caps. Most of us have fixed interest rates. So these higher interest rates don't really affect us at all, if you were smart about it. So really, there's always some kind of challenge for syndications or finding investments. You just have to figure out how to unlock them. And then kind of how that pushed us was, I couldn't find a lot of stuff here in Dallas Fort Worth. The prices came push up and up. And so we started doing development. I looked up, there's a group out of New York City buying a 1970s chiller deal in Southeast Fort Worth, which is not a very great place to own, very rough neighborhood, for $120 a door. And they were going to put 15 grand a door into it. Well, I'm building 88 unit complex for $195, brand new granite countertops, brand new ACs, so somebody's wrong and it wasn't me. So it's like, you want to look at your basis of where you're at compared to the market. and for what asset class as well. So that pushed us into development, which was great. And now that arm is huge and kind of leading the growth right now, today, just because the existing multifamily deal flow is pretty slow right now.
Kenny, I love what you just said, right? So the big takeaway for me is there is always a challenge when you are an operator, right? This business really comes down to deals and capital. And, sometimes the deals are plentiful. And that means typically capital is going to be somewhat sparse, right? And other times the capital is readily available, but the deals are hard to come by. So you're always trying to solve this equation of matching up a good deal with capital that is favorable with, good interest rates and good returns for investors and all that kind of stuff, right? And that is the challenge. So you are always finding that balance between those two things. And the thing that you did was you did a couple things. One, you started looking at other markets. Two, you started to look at development. So if you're having a hard time finding deals in your market that pencil, think about either adjusting markets, maybe changing your criteria a little bit, but also pivot to maybe a different strategy. Maybe it's development, maybe it's something else that you can do. But be patient, be patient,
Right.
but also take that feedback and figure out where you can find some other opportunities. For those folks who, the flip side of that equation is I don't want to be, just chasing the shiny object, right? And maybe I'm having a
Right.
hard time with this. So now I'm going to look in this market, or now I'm going to look for this kind of deal, or now I'm going to look at development, or now I'm going to look here. How do you balance kind of the focus that it takes to find a deal and be successful versus taking the actual feedback that, hey, maybe this isn't working right now for a reason we can't really change. We should pivot and do something different. How do you balance that feedback there?
Right. You got to be careful with the shiny object syndrome. Yeah, no, I totally agree. It really, I always took it. So Steve Jobs says a company can do 5 things very well. So I say, I told, okay, we'll do 4 and be very, very well at them. So that was kind of a limitation I put on us because there are a lot of great. There's a million ways to make $1 million in America. I mean, we live in the best country in the world. There's just a lot of opportunities. So you have to, but there's only so many that you do have to focus, right? And so my focus was existing multifamily for a good 6 years. That's all we did. To increase deal flow and find better deals, I did go out of the state, and had to figure that out. But then about 7 years ago, it was time to add those 2 other arms to our company. Because again, if you're so focused on one asset class, you basically have a stool with one leg. I wanted one with at least 3 to make it a lot more stable. I want to be able to, scale our company, keep our employees busy all the time. And so to do that, is branched out into Triplenet and development out of those 3. And between those 3, multifamily, development, and Triplenet, we'd always be busy. We'll always have jobs for folks up here, no matter what market we're in. And so that's kind of was the idea behind diversifying and adding 2 arms to the company.
Can you compare and contrast those 3 strategies, right? So multifamily, Triplenet, and development. Just compare and contrast those for us.
Sure. So your Triplenet, those are your real mailbox money. We talk about it on multifamily, but the real stuff is like a Dollar General, right? So Dollar General guarantees the rent. You're going to get paid every single month, and they take care of 90 to 100% of the operational expenses. They reimburse you for property taxes and insurance. So so on those we pay out monthly to our investors because it's so stable and steady. You're going to give up some appreciation because blessing and curse of those is that you have a long-term lease. So it's awesome. You have a long-term lease, 7 years left from Dollar General, but your rent increases aren't going to be there for 7 years, right? And they're not going to be as fast as definitely now as the inflation has pushed it up, right? So that's a limiting factor. But for those that need monthly stable cash flow, 8, 9, 10% a year, that's a great option. The multifamily is kind of a hybrid, right? So you've got cash flow and appreciation. You're going to make more appreciation in the Triplenet, but we have to chase rent and we have to fix toilets. So we do quarterly distributions on those because it fluctuates month to month of what do you actually make at the property. And then development is full on appreciation. So no cash flow for 2 to 3 years. But right around year 2 or 3, we're looking to do a cash out refi, get back about 50 to 80% of the investor's money. and then cash flow thereafter. But on paper, we should double the money around year two or three on there. So that's for folks that want more growth and have a little bit more risk appetite in their portfolio.
Yeah, I like that a lot because they play three different roles, right? Your triple net, straight cash flow play, right? Very little appreciation or some, but you're looking at long-term contracts. So in those cases, you're not going to see as much appreciation, but you got a solid asset, great tenant, nationally backed, retailer typically, or so you're going to get that. The blend is kind of multifamily where you get some cash flow, you get a little bit of appreciation. That's kind of
Right.
the blend, and obviously the thing most of our listeners are familiar with. But then on the other side, the development, that's going to be almost all appreciation. You get some cash flow once the property is kind of built and
Sure.
stabilized.
Yep.
But at that point, that's usually when you're looking to either refinance or have some sort of liquidity event to return capital back to investors. So it really just comes down to what you're focused on. If you want cash flow, you want yield, the triple net lease may be the best opportunity. If you want a great blend of both, go multifamily. If you really want to focus on appreciation, that development is the play. Let's just talk about developments for a quick second here. Developments certainly have grown in, I would say, demand over the last few years for the reasons we've talked about, right? Multifamily has become more and more expensive. When you start to look at the replacement cost value when it comes to what does it take to build brand new versus, an existing asset, that shrink that gap. So I think a lot of people said, hey, you know what? I'd rather just build a brand new asset than buy this asset that exists for 200,000 a door, right? I'll just build a brand new one. So we've seen more and more demand growing for that space. What are the factors that people should consider, particularly if they've never done a development? Because I think that it's one thing if you're a developer to go and do development, you know that space, but we're seeing a lot of people who traditionally have purchased existing assets go into development. So what are those things we need to be paying attention to if you're looking to get into development for the first time?
Right. So, before, so our first development was about some townhome lots across the street from our first syndication deal. And they were already zoned townhomes. I called up there 5 different times trying to talk to 5 different people to see if I could switch it to multifamily, and they all said no. I was like the kid asking the other parent, but they all said no. So I had townhome lots. It was 4 townhome lots. I could turn them into 6. So I wanted something where I could work with the city. I didn't want to rezone. I talked to some other developers, and they all kind of warned me, don't fight City Hall. That's somebody else's job. Go in buying land that's already entitled to what you want the project to be. So, but I did want something where I had to work with the city to either replat or, something just to get that underneath my belt. And then I didn't take any other investor money. I don't think I mentioned that. So I just put my own money into the deal because I really didn't know what I was doing. And so I didn't want to put any of our investors' money at risk. We got halfway through build and they were begging me to invest in it. And I said, no, it's already up, but no, not this one, the next one. So anyway, so I worked with the city, had to replat it to 6. I learned so much. We have crappy soil here in North Texas. And so they had to dig down 9 feet. I was hoping they were going to hit oil, but they didn't. And backfill with fresh dirt, clean, good dirt. And I know just the whole process, I learned so much along the way. But I think it's getting that development underneath your belt to be able to do it or to know it as there's a lot more moving parts, I guess, is what I'm trying to say. And so to do that, have one underneath your belt is almost a bigger deal for me than existing multifamily that's already running. It's already stable. You've got, investors or you've got residents already in there. Development is way more complex. We had our team run out. There's 160 steps to get from acquisition to a complete project. There's no way there's 160 steps on existing multifamily. So you've got to get those underneath your belt. So we did that. I did that townhome deal. It was great. Doubled the money in 3.5 years on it. And then I felt we were ready. I built the team around us for that. And then we bought 6 acres, raised the $3 million we needed in a day. It was so fast because we could point to something we had already done and completed. And so we raised the money, and so it was 6. I built 6 townhomes, and from there scaled to we're building 88, our second deal, right? But to point to something you've already done is a huge deal.
Yeah, I love that. Would you say that new development. So again, not so much the entitlement process and everything that goes on there, but the actual construction. Would you say that it's easier, harder, or comparable to kind of a medium renovation project for an apartment building?
Oh yeah, no, this is on steroids. This is a rehab project on steroids. I mean, because you've got to figure out, and there's always curveballs too. Like we're doing a development across from Cleveland Clinic right now. It looked like we bought like 6 house lots, two with 2 houses on them. The rest were vacant. Well, we're doing some dirt work, and they pushed in as part of the house underneath there. So we now have an archaeological dig, digging stuff out of there, found like old washer and dryers and stuff. So anyway, so there's always curveballs on that stuff, but it's working with the city, the permits, the supply chain issues. We had to work through that the past couple of years. So there's just a lot more stuff to work through compared to like even a heavy existing multifamily rehab deal.
Yeah, and with the changing landscape on all these deals right now, like how are you kind of prepping investors? Like, what are you telling them as far as what to expect or any kind of changes in the landscape?
I tell them I'm biased, but I really believe rents can only go up. Inflation is here to stay, no matter what they try to do. When the demand deposits in November of 2019 was 1.7 trillion. June of 2020, it was 5.1 trillion. So when you put that much cash into a system, we're lucky our inflation has only been 3, 4, 5, 6, whatever percent, whatever it was. We should be Argentina right now. you know, so with that, inflation's here to stay. Two, we have we're undersupplied in housing across the United States. Every market's different, but well, we were maybe about a year ago 3.6 million housing units short across the United States. It got worse when the interest rates started going up. The single family developers really tapped the brakes on building new product. So we have inflation on our back. We've got demand way outstripping supply in all the markets that we're in, for sure, there as well. So when you have that, it's just your rents are just gonna have to go up. There's no other way. And that's such a big driver for value for us on the investment side. Is it going to be choppy? Absolutely. Lending is crazy right now. You have to be very nimble. You have to know the right people to call, how to adjust quickly too. And now Fannie and Freddie are pretty much back, which is good. Not as high a leverage, but they're off their lows as well. So really it's being nimble and being able to adjust, equity, debt, and deal flow.
And
But long-term rents will be there.
yeah, and I think one thing that's interesting with you and your team strategy is like, you've got stuff in the DFW and Texas market, you've got stuff in Cleveland. I know you're in a couple different markets. For me as an investor, I might look at that and say, hey, those markets seem drastically different, right? And I'm a Clevelander. I'm born and raised in Cleveland, so this is not a shade to my hometown, right? But I very rarely hear people say, two of my top markets are Cleveland and Dallas, Fort Worth, right? So can you just explain kind of your rationale and kind of how you look at going about a new market and what you liked about both of those markets that made you say, hey, yep, let's continue to grow here?
Sure. So our first jump in Ohio was actually in Columbus in 2015. Really it was looking at they hadn't in 2015 they hadn't hit their 2007 peak per door prices yet. But Columbus grows like clockwork. It's the capital. It's the home of the Ohio State University. I've been trained to say it properly.
That's right.
But it's just a great town, right? And so we were buying there, and then Cleveland popped up in 2018, and really just kind of started looking what's on the market. We bought our first deal there. It was a mid-rise deal, 126 units. For 32 a door. Average rents for us were $650 a month. It's like, where do you see a 2% rent to per door price? Like nowhere do you see that. It was insane. And so we were one of 2 people bidding on that project. But everybody knew Amazon was building a brand new distribution center caddy corner to this building. And so I knew rents were going to go up. So really that was our first jump into Cleveland. And it is a totally different market. We really like the development there because they hand out, at least through the end of this year, a 15-year no strings attached 15-year property tax abatement, which is absolutely huge. So when you can find those markets like that, and take advantage of that, and the opportunity zones in Ohio, especially in Cleveland, were in really great neighborhoods. Not sure if that was the intent of the law, but we're all playing with the same rules. So but the map is just phenomenal, of where the OZ was to those OZ areas are. So a lot of our opportunity zones up there as well.
I love it. And I think it just goes to show that, a lot of times we lock into key metrics like population and industry diversification, and those things are really, really important. But sometimes it also is you have to understand what everyone else is doing, right? If everyone, all of your competitors are reading the same data and going to the same market to look for the same thing, well, there's going to be opportunities somewhere. So if you can step back and take a look at the marketplace and understand, hey, what kind of returns can we get in different markets? Do we have any other advantages in these markets? And you talked about, the 15-year property tax abatement. You talked about the opportunity zones, but actually in desirable locations, desirable submarkets. Those are the kind of things that allow you to find opportunities that others may miss. So, we're big fans of understanding how to find the best places to invest. But part of that process is learn the rules of the game, so then you can figure out where you make adjustments to it. And I think you've been able to do that with your strategy so far. Kenny, for folks who want to learn more about you and your company, they can go to wolf-investments.com. Again, that's Wolf, WOLFE investments.com. Kenny, we're going to go to a round of insights. You ready?
Let's go.
Give me a failure or an apparent failure that sets you up for later success.
My wife and I, right out of college, bought a tanning salon. So the big lesson there was, it was run mom and pop, but our goal was to grow it big enough to where we could get a manager in there and run it, so we can have more of a hands-off kind of passive investment. The big lesson there was, because we could never get it there, we could never grow it that big enough to, get my wife out of working in that business. But really, it was go big or go home. Like if we're going to do this, I need someone else to handle the day-to-day operations, because I don't want to do that. I'd rather scale the business and grow the growth. So that was a huge lesson for me, anyways. On the being able to scale is really start as big as you're able to, because it's gonna grow a lot faster if you can.
Give me a digital or mobile resource you recommend for your business.
Man, for our business growth, a huge book that really took our business to the next level was Traction. And so we implemented that EOS model up here. We do it every quarter with our company. I highly recommend it. If you're looking to scale your business, that book Traction is it's a life-changing book, or it was for us.
Give me the book you've recommended or gifted the most in the last year.
Oh man, probably my own. We do that a lot. We host big conferences and hand out books and stuff. And I just dropped a second book about 2 months ago as well, more of a personal finance book. So that's the one we've been handing out the most so far.
All right, we'll make sure we link to that in our show notes there. Give me a daily habit that helps you stay focused on your goals.
Oh man, my day is way better if I go to CrossFit in the morning, get a workout in, just be able to focus on that. It's more about burst speed and everything like that. So be able to check out, get energized that way. It's a big plus for me.
Give me your number one insight for real estate investing.
You want to fish where people are going to fish later. And I mean that by, Columbus, Ohio is not the cool place to invest in 2015. But now we get calls every other week about people want to buy our properties in Columbus, Ohio from California and New York City phone numbers. So you want to be one step ahead, if you can, on markets, if you're going for new markets.
I love it. Well, Kenny, you are based, I believe it's still in DFW area. Give me your favorite place to grab a bite to eat.
Oh man, so I'm vegan. So best vegan spot, Spiral Diner. There's a few locations here in town, but that's my favorite.
All right. Well, Kenny, listen, I appreciate your time today, man. You gave us some great information. I love hearing your journey, and even as I heard you talk about the apparent failure. That ties into, I think why you started with that 76 unit, right?
Absolutely.
and starting big as you can, starting as an LP first, doing those deals, getting into that 76 unit, raising 825,000 for that first deal, no small fee, and have been able to grow to $675 million in the portfolio today, on pace to hit $1 billion in assets. So again, we look forward to watching you continue to grow. I think the big lesson and big insights for us are start as big as you can, look to scale, look to hire, and make sure you are running it as a business. But also, don't be afraid to look for other opportunities. If you're having a hard time finding deals, look to pivot, look to expand, look at ways to continue to grow. And that mindset, I think, is key if you want to get to that next level of success. If you want to learn more about Kenny and his company, you can check him out at wolfe-investments.com. Again, that's Wolfe, WOLFE-investments.com. Kenny, thank you again for coming on Multifamily Insights. We look forward to staying in touch with you, and I hope you have a wonderful day.
Appreciate it. Thanks. Bye.